thank you all very much for coming to the session on emerging markets and investments. And I think it's going to be a fantastic panel because these specialists are going to tell you all you need to know about investing in emerging markets. As Chief U.S. Economist at Citibank and now Chief Economist here at Milken, I have to say where my prejudices are so that you know where the moderator is. In 18 years at the IMF, I've never been to an emerging market other than Hong Kong and Singapore.
Hardly emerging.
and most of my life has been as dealing with capital markets and investors like yourself and asking the question, where do I invest my money? And often when I talk to my emerging market colleagues at the IMF, why emerging markets? So that's really the focus and approach that we're going to take on this panel. And I say these are great experts. I'm going to dive into it right now because on my right here is Hani Buteke. Sorry, I messed this up. He's vice chair of the KBBO Group and chief investment officer of NMC Healthcare. And on my right, immediate right, is Penny Foley. She's the group managing director of emerging markets of the TCW Group. On my left, Anita George, executive vice president at strategic partnership and growth markets of CDPQ, India. And on my far left is Bart Turtleboom, CEO and executive director of APQ Global. And Bart and I share a little bit of overlap. He actually was at the IMF and actually did real work there. And then he decided, I can't be a policymaker anymore. I'm going to go make money. So his investment expertise, I think, is going to do us quite well here. So the way I want to start the session is to say, why emerging markets? After all, the U.S. has been growing, and it's one of the longest post-World War II expansions. The stock market's booming. The returns here are phenomenal. We're attracting money like a global capital market magnet. So I have to start the question off on saying and talk about these global macro influences. If all of the influences seem to be the technological change and all of the growth is in the advanced economies, less so in Europe, but certainly in the U.S., why should you be putting money into the emerging markets? And often the answer comes back, boy, they're growing quickly. They have great demographics. The young population is there. The growing middle class is there. All the opportunities are there. But you have to take some volatility. So let me start that off. In fact, Hani, I'm going to ask, since you come from the part of the world that has all of these characteristics, great demographics, great growth opportunities, how do these other macro influences influence the global investor to come to you? And what do you think about, say, the Fed normalization, what it does to currency risks? And talk to us a little bit about shaping the framework for how an asset allocator would choose emerging markets over advanced economies.
Sure. So thanks for having us today. We've been investing in quite a few sectors that we see a lot of interest coming through investors out of this part of the world. Definitely, as you mentioned, there's a lot of interest in U.S. markets today, but I think people looking to diversify and look at larger growth in emerging markets, in various sectors. We have a big investment in healthcare, as you mentioned, which is growing at kind of very large double-digit growth, 20-30% in some areas. And we have big names out of the U.S. invested with us in that public entity, the likes of BlackRock, Wellington, Fidelity have stakes in these entities where they look at our part of the world in certain sectors where there's limited currency risk, and as you mentioned, big populations. As you mentioned, certain services where population is young. We have a large IVF business, for instance, where you have a lot of people focusing on getting a lot of people getting married later in life, freezing eggs, and we've taken that business into a global arena today where we have assets all over emerging markets. We're looking at China due to population, looking at India as well and other markets in our world. The main issue I see when we're speaking to international investors and namely kind of invested in developed worlds is looking as you mentioned the big growth, looking at countries where there is minimal currency risk, minimal kind of vulnerabilities, security risk and what have you, but also looking to diversify their investments. You have a lot of capital today yielding close to zero in certain countries. You look at Japan, you look at other countries where there's not much yield. So they look at us as growing economies, as you mentioned, emerging. So there's still a lot to happen in our part of the world. Look at UAE, you look at Saudi, you look at Egypt. A lot of these areas are growing populations, and we've seen a lot of success within our part of the world. I think what is important is kind of teaming up with the right, kind of right people on the ground. You've also seen a lot of big transactions recently happen with large U.S. names entering our part of the world. You have, Uber buying Careem. You have Amazon buying Suit in the UAE. You have obviously BlackRock, KKR doing big deals in the region as well in Abu Dhabi, and the likes of that. MasterCard just took a big investment in Networks International. So we're seeing definitely a lot of focus on our part of the world.
But are you seeing that the money that comes in, are they the kind of money that will stay, or are they the sort of short-term things that will be influenced by if the Fed starts to renew its normalization process and rates start to go up here? If Europe actually gets out of the negative rate period that they're in now, will the money start flowing out?
I mean, you have some long-term investors. If you look at the last quarter of last year, November, December, obviously when there's any volatility, some of the large names, sell emerging markets first, and we've seen that in a lot of public companies. On the private side, you do have long-term money that is parked there. We have investors in our company that have been investing, have come in and done tenfold their money and are still long-term investors.
Let me turn to you, Penny. Mm-hmm. You are very heavily weighted into the public fixed income markets.
Right.
And so you certainly are facing, your investors are facing these decisions about where to go and how to diversify. Can you talk a little bit more about how the advanced economy versus emerging market decision is made and how it influences your portfolio?
Sure. Well, I think traditionally people have gotten, U.S. investors, developed market investors have gotten their emerging markets fixed income exposure through global mandates. And increasingly, we're seeing institutional investors move from that approach to having a standalone emerging markets fixed income allocation, because today emerging markets fixed income is 20% of the global fixed income opportunity set. And if you look at so we've talked about, I mean, obviously the better growth environment. Also, the thing that really drives, in my view, alpha in our markets is a change in direction from a policy perspective. And that's often, they've tried every bad idea that's available to them, and they ultimately get to more orthodox economic policies, often assisted by the IMF. Those are the kinds of things where you can see huge equity-type returns in very short order as people move from a much more heterodox economic policy to much more orthodox. And you also, if you look at relative value, our portfolio, which is a double B portfolio, yields about 6.5%, 6.75% in a world where you've got 10 trillion yielding less than zero and 40% less than 2%. So that's a pretty compelling relative value story. In terms of absolute value, we're probably trading at around fair value. We're trading at around 350 over treasuries, which is the long-term historical spread. It's about midpoint between the tights in 2018, which were 265, and the wides at the end of last year of 420. So I think going forward, the early part of the year, the index is up 7%. So obviously reflecting a bounce back from the fourth quarter, and also some of the much better environment we're in now, which is the Fed pivot, a little less angst around the U.S.-China trade relationship, and the beginning of green shoots in China growth, and we're waiting to see a pull through to Europe.
We'll come back to China in a moment. In fact, let me turn to Anita. Add some more to what Penny said, because the fixed income world is the public market world, and in your portfolios, talk a little bit about how, again, this global trade-off between, do I park more money in overvalued S&P 500, or do I go to an emerging markets where I may not see returns for years and years? How do I resolve that, and how do I tell my own clientele it's worth coming to emerging markets?
Thank you. I think from our perspective, CDPQ as a long-term institutional investor, we're really looking at why not the whole world? So why leave out emerging markets? We have a bigger canvas to pick and choose from. So I would say that's our starting point. In terms of asset classes, we are also diversified across 5 asset classes. So we have the illiquids, infrastructure, real estate, and private equity. And the liquids, which includes our fixed income as well as listed equities. So I think it's finding for our depositors, who are the ordinary citizens of Quebec, the best combination that they can choose from. So this gives them both the entire universe in terms of investment canvas and asset classes across different
I'm sure there are people in the
assets.
audience right now asking the question, well, diversification is nice, but why is Warren Buffett not right also when he calls it diversification? It just, I mean, you're picking low return areas that are uncorrelated, or high return areas that are uncorrelated with my other markets. But if they're not growing as rapidly in terms of valuations, and some markets are illiquid, and I have worries about the accounting information for me to make judgments about where good picks are, which is why we go to experts like you. Why would I put up with that kind of risk?
So I think I'll go to what Hanny said. And in emerging markets in particular, we've been very selective. So in terms of the countries, we've focused on Asia and Latin America. And sorry, Hanny, we'll get there. But in terms of the way we do our direct investments in particular, and so we avoid all of the sort of attributes that you just described, is to look for trustworthy partners, because we are long term. We want to build businesses together with partners who want to do the same and who are not sort of coming in and coming out. We also really look very carefully in terms of who's the best partner that we can work with in a particular sector, in a particular asset class. So there again, I think, you shortchange yourself if you define your universe very narrowly. And one of the things, even as we've been very selective on the choice of countries, I keep saying that you have to pick the right partner in the right country. And you get first dibs if you are. and every country, I would say, presents those opportunities where you have, the most high integrity standards, the most experienced, the firms who've been in a market for 100 years. So that's one aspect. The other is that we also look at new trends. And again, if you use the same brush of, very risk-adjusted yields that you want to see year after year and avoid the volatility, I think you also miss opportunities.
I think that's a very important point, that these 100-year-old firms and these long-standing institutions, the few of them that there are there in the many emerging markets, can't be really relied upon, because technology has just disrupted so much of what was supposedly normal practice. And so I think this point of picking the right partner who recognizes how technology adapts is probably one of the hardest things to do. And knowing the right people, like Bart, is helpful. So I guess, Bart, weigh in on this. Weigh in on again, why emerging markets beyond diversification, perhaps? Is there anything else? Do you have access to, say, private markets and private equity, private debt, that would be better suited for a long-term holder?
Yeah. So, well, thank you very much, William, for the invitation. Let me pick up on what you've just said and what my fellow panelists said here as well, right? And when I listen, I hear a couple of buzzwords, right? I hear growth, long-term growth of emerging markets. I hear patience. You need to be patient. You need to be in there for the long term. And I hear the Fed pivot funding costs. And let me just pick up on all three of them. The single best predictor historically of the return of emerging markets debt is the short-term interest rates in the United States of America. Nothing to do with emerging markets. That's what drives it. If Fed funds go to 3 and the 10-year goes to 5%, I have news for you. It's not going to be pretty in emerging markets. Why? Because a lot of debt was issued. And why was it issued? Because they could. and they could issue at very attractive levels. So let's not forget that we are coming out of a totally extraordinary period post-2008 with very low interest rates in Japan, in Europe, and in the US, which has led to a lot of flows into this asset class. Now, one of the worst reasons to invest in something is because you have the money and you don't know what to do with it. It's just generally a terrible idea. Now, I'm not saying that all that money that went in emerging markets went in for the wrong reasons, far from it. And to Penny's point, it's such an important part now of global fixed income markets, and the underweights are so significant in a lot of Western portfolios that clearly a diversification strategy in emerging markets from a medium-term perspective makes tremendous sense. However, let's not forget one thing. The diversification need of Chinese institutions and Chinese individuals out of China is much bigger than Western institutions into China. Why? Because they've had capital controls. They couldn't get out. I mean, I read some, I forgot the exact details, but it's like 60% of the millionaires in China want to emigrate. I mean, don't quote me on the number because it might be off, but it was an astoundingly large number, right? So this is going to be a two-way street, and it leads me to the second point, the growth point. The argument I often hear for investing in emerging markets is what has been said before, and you've heard it 100 times. It's the fastest growing part of the world economy. It's becoming a very big part of the world economy. Add to that the demographics, add to that all the sort of stuff that we know about the growing middle class, and it's there. But I would argue that, and it's certainly an experience that we've had and played to very good effect, is a very big reason to invest in emerging markets is not the growth, but the value. And I'll give you two examples of that. Petrobras, in 2016, the stock had gone from 50 to 2. The market cap had gone from 300 billion to 20 billion. And they had issued a 100-year bond denominated in US dollars at 80 cents on the dollar. That was the issue price with a yield of around 8%. And then the stock goes to 2. When a stock goes from 50 to 2, it ceases to be an equity. It becomes an option on an equity. One of two things is going to happen. It's either going to go to 0 or it's going to go back to 10. It's not going to go from 2 to 2.1 and sit there for 5 years. That ain't going to happen. So now we looked at that, and obviously there was lots of corruption. You had the political scandals in Brazil. I mean, this was not a pretty picture at all. But we said, you know what? It's an operating company. It has real revenue. Yes, it might be overstated. It might be this, that, and the other. Do they have corruption issues? Absolutely. There are lots of stuff. But you know what? This thing is not going to disappear. The stock is at 15. The bond dropped to 60 cents on the dollar. 60 cents on the dollar for a 100-year bond. You get 6 coupons. You have your money back, and you have the rest as a free option because rates in the US are 0. So the point I want to make here is do not underestimate the value proposition. Turkish banks last year, same story, completely lost 80% of their market cap in 1 month in US dollars. 80. You know what? Trade at 0.1, 0.2 book. Again, was an interesting proposition. Now, what it argues for is obviously stepping in when everybody runs away. Mm-hmm. And that leads me to the point that you just made, Anita, and that is patience and the long term. I have very terrible news for this room. I've done this for a while. And if I would draw a chart of all the investors I've had who said they're in for the long term and how long they've stayed in, it's not a pretty line. And that goes from a retail person in Spain who put in 100 euros in a UCITS fund all the way to the largest institutional investors in the world. It's absolutely true. You have to be in it for the long term. You have to tolerate the volatility. You also have to time your entry a bit. Mm-hmm. Yeah. Don't forget that little bit. And you have to do it, but it's easier said than done. And everybody has institutional constraints on how they need to manage the money.
And Bart, I think that's a fantastic point. You brought up China because we can't talk emerging markets without talking about the big elephant in the room. The world has shifted its trade patterns. One of the studies that came out of the IMF recently, I don't know if you saw it, Bart, was that as tariff rates went down around the world, they started to shift supply chains and trade patterns. And what happened was, as tariffs have come down over time, what you noticed was that the trade patterns that used to be very Eurocentric, Germany, right, Italy, UK, France, that started to dissolve a bit. And at that time, China was just a small part of the trade network. Now what you're finding is that the supply chains that have formed, because with lower tariffs, you can actually start specializing in production. You start to see China becoming the hub of a huge Asian supply chain. So that shift in the patterns of trade that have become more China-centric makes it much more important to focus on what's going on in China. And let me start with you, Penny. The public markets in China, again, we talk about difficulties of getting information, relevant accounting information, reliable accounting information. One of the favorite papers, I don't remember if you were at the IMF at the time, but certainly when I joined the IMF, the most popular paper to write was, why are there no capital markets in Asia? And why is it so bank dominated? In part, it's because family-owned businesses don't like to reveal what's going on. So as you do your due diligence in the public markets, especially in the fixed income markets where you worry about covenants, you worry about getting your money back, how do you approach China?
That's all we need to worry about.
Yeah, that's it. You don't care about the upside. Bart's upside is totally irrelevant to you.
Pay me back, that's
yeah, just
all.
pay me back my capital, right? I let you money, I pay back. So how do you deal with emerging markets, but China in particular, and has it gotten better, and how has it gotten better, and is it still suitable for only institutions, or are there other audiences that might consider China as an investment?
Okay, well, we're fixed income oriented, so China is a huge part, a huge important part of how we look at the world.
Let me add, by the way,
Yeah.
China has huge debt, so they've issued a ton of this stuff,
Right.
and you have to pick and choose.
Well, we don't really invest in Chinese government debt. It's just not attractive from a value perspective. We do invest in corporates in dollars in China, and that's a small part. It's a small part of our index. It's not even in the local currency index, although it will be, I think, in the next 18 months. So we look more at China for, what's happening globally. Are you seeing growth in China? I mean, from our perspective, we're largely invested right now in dollar-denominated debt. Local currency, I think, is clearly a potential opportunity, but there's no real yield differential between local currency and dollar debt right now. So you don't have any cushion for FX volatility. What we're looking for is better growth in China and having that pull through in Europe. We've seen beginnings of green shoots in China, but not an awful lot.
Latest data put that into question now, right?
Well, I think the latest data, they're still growing. I mean,
Yeah.
still above 50. And I think what this does and why the market reacted the way it did was because it keeps the authorities from moving back, stepping back from their policy of stimulating the economy. So I think it's sort of a two-edged sword, if you will. But I think it's very early days to say that we're out of the woods yet on China. Where we've been investing in China on the fixed income side is in dollar corporate debt, which is largely real estate. There are about 35 issuers in the real estate market in China. We're very selective and are invested now in 2 names.
The old statement they always make about China is China can only stimulate the economy one way, which is through credit. And as they pump credit into the economy, it all goes into the property market bubbles of Shanghai.
Well, they're
Beijing.
now focusing on the fiscal side,
They're
not
trying,
just monetary.
but that has not been so successful yet, and they'll take some time.
It will
right?
take time, as always. And they're also being much more careful this time, just in general. They really suffered from the excesses of the 2008 stimulus and are being a little more careful, which is taking a lot more time. So we're very careful on the local currency side, much more aggressive on the dollar side now, but we think local currency could be very interesting opportunity in the second half if you see stronger Chinese growth and have pull through in Europe, and you're beginning to see just a little bit in Europe.
And I guess the challenge for you, Hani, is emerging market to emerging market investment. As everyone says, you need to diversify somehow because it's not good to put your eggs in one basket. But as an emerging market to emerging market, when you look at China compared to, say, your own region, what are the glimmers of opportunities you see there that are not available at home?
So I would probably focus on our one of the businesses we've invested in, which is the IVF business that we're looking to set up something in China with that. I think as Bart mentioned, timing is very important and partners is very important. China's one kid rule showed them that it kind of limited growth there. So today there's a change in that. I was there last year at the World Economic Forum that they hosted in China. And we've met with a few of the healthcare partners there, and it's the population growth and the amount of people that are in China is just tremendous compared to our parts of the world. So we have hospitals ranging from 100 beds to 500 beds. We own the largest hospital in the UAE, which capacity is around 500 beds. China, we visited one hospital where they said there's 18,000 beds in that hospital. So looking at the IVF space there's huge opportunities. There's, as we mentioned, there's people getting married later in life. There's egg freezing. There's technologies that we've acquired a company in Spain called Eugene on the IVF side. So, we like to acquire businesses in developed markets to gain their technologies and take them into our parts of the world and into other parts of emerging markets that we see we have an added value or an advantage compared to competitors there. We're looking at China today to enter with the right partner and at the right timing and make sure we benefit from that. Because if we get into something, we want to get into it for the long term. And having that partnership is very important to make sure we don't have any hiccups, during that period.
And certainly with the many beds they have there, it's going to be filled more and more with older and older people because China's demographics is sliding down very rapidly.
Yeah.
The aging population is on the same trajectory as Japan.
Yeah.
And so when you think about that opportunity, Bart, how can you say China is a great growth opportunity for the long term?
Well, as you mentioned, it has the demographic challenges. It's probably going to go into a current account deficit. It has the challenges that is going to come from the growth in the debt market. Now, that cuts both ways, obviously, right? If you start with very low debt to GDP ratios and you have income convergence versus the rest of the world, you expect debt to GDP to rise. I mean, issuing debt cannot be the prerogative of IBM and nobody in China. Mm-hmm. That's just obviously a bit of a nonsense. But having said all that, you have these very significant challenges. I don't believe there is a big beta story in China. But I do share Hani's view that there are very specific stories. Mm. And that story that you've mentioned, I think you've mentioned in the context of China with a hospital with 18,000 beds, but those stories are popping up in emerging markets globally. And they're popping up and becoming more interesting because we're in a phase of deglobalization and balkanization. Right. The world is changed. I mean, let's not forget, why are emerging markets where they are today? They're here because decisions were made in the West under multilateral institutions to bring them into world economy, reduce trade barriers, reduce barriers to move across borders, give access to education in the US. All these things were very important factors, and these are now being reversed. So the idiosyncrasies that are going to come from this asset class are going to significantly increase. They're going to offer very significant opportunities, and they are going to turn it into less of a beta bet on global growth.
I know the audience is going to crucify me if I don't squeeze you for real investment information, right? So, of the opportunities where there's alpha generation in China, I know that technology is very much into China's national policies. They want to be standard setters in 5G. They want to be standard setters in biotech, artificial intelligence, facial recognition. And in fact, one of the arguments that the U.S. is having with China is to define the markets for which each country can have market access and to scale up those industries so that they can benefit from the returns to scale and to essentially be able to ensure intellectual property as you trade across borders. So if you look at China, where are these alpha generating sectors and investment opportunities that you would be considering to be prime investment candidates from a technology perspective?
I think you've mentioned them in addition to technology is logistics.
I don't get paid for doing this kind of stuff, but it's got to come out of your mouth.
I think logistics. I'll tell you a story. If anybody ever wants to go from Brussels to Luxembourg, It's one of the most dreadful things to do because it's 200 kilometers, it's too short for a flight, and it takes 4 hours on a train. However, if you're cargo, it takes 2 hours because the Chinese have taken over the railroad. Why have they done that? Why do they care between Luxembourg and Belgium? Because they're building a global supply chain back and forth from the port in Antwerp to Austria. So, I mean, there are tremendous opportunities in that type of stuff. How investable they are is a very different question, right? And I want to urge some caution on that. But I think that the world is in a very strange way becoming more multilateral as the US retreats. And that is going to offer fantastic opportunities. You've mentioned technology and the projection of Chinese national policy abroad. Obviously, that is a big story. We know the Belt and Road initiatives. We know the criticisms of the Belt and Road initiative. Then there is the domestic story, the healthcare story, the education story, all these type of things. And it's going to be, I don't want to cop out on the question, but it's going to be truly diving deep in individual stories, hooking up with the right partners, and being in there for a while.
When I was at Citi, we projected China is going to grow at a pace that'll overtake the size of the U.S. by the year 2030. But you know what's going to happen by the year 2045? India will overtake China. Anita, certainly you've heard the questions I've asked, so I'm going to focus on you to say why India, what's in India, what should we be looking for in India, and where are the opportunities?
So I think in India, if you look at it in terms of the trajectory of what has happened in the last 20 years, you know, we went from the sort of Hindu growth rate to post-1991 to a much more, higher growth rate, compounding year on year. And there's also a story, and I think when we talk of China and India, you have to remember that this is not one monolith economy. We are talking about, in India, for example, 29 states, some which have a GDP per capita of $10,000, some which have like $400, $500. So it's really, as I think Bart said, you have to get to know these economies. So why India? I mean, firstly, and I'll repeat them for everybody's benefit, the demographics. So 65% of the population is below 35 or below. I would say democracy, which is something which people don't talk about. So it's more chaotic than what you would see in other places. But there is some method to the madness. And a key aspect, I think, in India, which has always impressed me, is the entrepreneurial drive. And that's something where you're starting to see, whether it's in the digitization and tech-enabled space, as well as in very basic places like healthcare. So this whole concept of physical combined with the digital is being scaled out in India. The third and last thing I would say is that a lot of these Indian companies are becoming global, similar to China that's looking for opportunities across the globe. We are seeing a similar trend in India. But of course, none of this comes without challenges. And one of, I think, India's, I would say, secret weapons could be to really learn from China. How do you grow sustainably so that you don't have the big cleanup problem that China has today and China is dealing with?
You mean the environmental cleanup?
Yes, the environmental cleanup. The second is, all the sort of things that scare people about growth markets in terms of transparency, corporate governance, the efficient working of markets, both on the debt side as well as on equity side. I think these are things which the Indian regulators are slowly waking up to and seeing that if you want to attract capital, you need to make those changes.
The one lack of transparency I've always heard from my colleagues at the IMF who've gone to India and are on the India team has been this notion of you need 2 stamps to get everything done. Tell us how you feel that kind of bureaucratic overhang, which, by the way, my friends have always said, the best thing about India is the fact that they've had British education and have English. But the worst thing about India is they also benefit from the British bureaucracy. And so how has that British bureaucracy overhang from the old days been changing, or has it just gotten worse and become amplified?
So I have to quote a very good friend of mine who's British. And whenever, he'd complain about India, I would say, well, you guys taught us all this. And he would say to me, well, if in 70 years, if you haven't unlearned it, you deserved us. But I think more seriously, there is huge changes. And the changes that I see are despite the government. So, for example, that entrepreneurial drive, the fact that you have connectivity, 600 million mobile phones, the millennials, despite income levels, being able to access education, information, aspiration. I think those are the things that are really going to drive India's future.
Right. I would be remiss not to talk about vulnerabilities and what vulnerabilities scare you the most as you look around the world and allocate your portfolios. Hani, what scares you from your part of the world? What is it that keeps you up at night?
Regulation is one thing, obviously, that has been changing a lot in all parts of the world. So on various fronts, that's something that is keeps us up. You have changes within that side as something. As we mentioned, there's human capital and bringing people in. I mean, something we didn't touch on, and something that Bart mentioned is kind of in emerging markets is where there's value. You have the UAE today, has built an infrastructure that has allowed a lot of people to move in and has given, anyone you want to recruit in or bringing in human capital has been easy for us. In other parts of emerging markets, it's not as easy to have talent move from developed markets. Bringing someone in from LA or New York or London into some other cities is difficult, language barriers and what have you. So that's another one. Innovation and technology is also very up there. On the healthcare side, you have I visited the clinic in LA yesterday where it said in the last 100 years a doctor's room hasn't changed. The devices haven't changed. And the guy we met was mentioning how the devices that you go in, how you take blood, how you do all of these things hasn't changed at all. So we're seeing a big technology push within the healthcare side, and that's something that we have to stay ahead of to be able to kind of carry on and be up there within that sector that we're.
Let me ask you more specifically, because Christine Lagarde was asked while she was at this conference, what is it that we can learn about how the rest of the world has adapted its healthcare so that it doesn't suffer a lot of the difficulties we have here in the U.S., which is hugely rising costs and somehow the sense that the healthcare is becoming less and less effective in terms of mortality or just well-being or diseases within hospitals. As someone who's importing technology, importing best practices, what do you see as places around the world that you guys are importing in, and how are you adapting it to your region, and do you think you can overcome these difficulties?
So definitely knowledge is something that's very important, bringing in the right technologies. As you mentioned, everyone's moving away from keeping people in hospitals. So you want to keep people out of hospitals as much as possible, which means running the right tests, diagnosis, new medicines and what have you is something very important. So that's where we're putting a lot of focus on the right partnerships, and the US has a lot of these technologies start out of here. So we have partnerships with Cincinnati Children's Hospitals. We have another partnership with Boston Children's Hospital. We're looking at different entities where we can bring in that technology and make sure you're reducing costs, but you're increasing efficiencies. You're keeping people healthier. The rate of people staying out of hospitals has changed, and the age of people has really grown in a big way. So 20, 30 years ago, people living, or more than that, living up to 70 and 80 was much less than it is today. Today, people are living into 70 and 80 and being very healthy. So that's where we're really focusing on. You have new stuff such as stem cells. You have different areas of keeping people up and running. So that's something we're focusing on.
So Penny,
Yeah.
Hani seems to be answering my question of what keeps you up at night by saying, I can get some sleep because I'm importing growth opportunities, and I'm importing things that will make my environment better. As a fixed income portfolio manager, again, you don't care about the growth opportunities. You just want your money back. So what is it what are your scare stories? What are the things that worry you about your emerging market portfolio?
I think they're probably one short-term and one long-term. The short-term one is a surprise acceleration in inflation. You don't see it. It's been there are a lot of structural reasons why you can say this time is different, but it usually isn't. So I think inflation is the one thing that would keep me up at night in the short term. In the longer term, and this is EM in general, is the move toward deglobalization, populism. You have now 30% of European countries run by populists. They've been pretty constrained in their policies, but the next generation may be a little more aggressive. And if you really have a major move in that direction, you're looking at slower growth globally, you're looking at lower profit margins, and you're looking at a much steeper Phillips curve. So those are the sort of the longer term things that keep me.
The fear of every fixed income portfolio is unanticipated inflation, where the interest rates didn't quite cover it. Anita, again, your worries, your scare stories.
So I think the most sort of disturbing or thing that worries me most is the job creation that's not happening. And when
high income job creation. I mean,
yes, both high income as well as just from the threat of technology, which if you look at the last 5 waves, we can get comfort from the fact that yes, there's some disruption, but then it picks up and you again have, but people need to be retrained. So that's one thing that we are asking ourselves, are we ready for those disruptions, which could actually be transformed into opportunities? And I think, even as long-term investors, we are so preoccupied with the here and now, inflation, interest rates, exchange rates, that you forget about those kind of longer-term issues, which become
less long-term. Look at Yellow Jackets, and look at all of the kind of political turmoil, and as Bart was saying, the balkanization, the deglobalization that's going on, because populist pressure is not recognizing anything that any benefits of technology, any benefits of trade. So certainly those are things that the social movements are there. Bart, you want to add to that? You want to add to sort of it sounds like you're agile, you're looking for opportunities. That doesn't sound like much scares you. So what does scare you?
Well, on a short term, what Penny said, right, rise in inflation. It's, as she said, it's not something that looks imminent. But then again, as Milton Friedman said, inflation has been, is, and will always be a monetary phenomenon, and we know what monetary policy in the West looks like. So let's not forget that. Longer term, 3 concerns in short order. First, climate change. How are we going to deal with a population of 1 billion in Nigeria with climate change? This is a significant thing. We should not forget, one of the reasons Western Europe and the US are what they are is because historically they were close to fresh water, they were close to seas, and they lived in moderate climates. Let's not forget this as a concept. That is clearly turning against emerging markets, and it's going to pose significant challenges. Secondly, you mentioned earlier the young population in India, the young population in a lot of emerging markets. Combine that with significant technological progress, AI, and all the other stuff that's been discussed at this conference, this is going to pose very significant challenges for any democratic regime. We see what challenges it's posing in the West, where we start from GDPs per capita of $30,000, $40,000, $50,000 per person. Just imagine the challenge that is going to pose. And the third one, which is related to the technology point, is this. The catch-up in income per capita from emerging markets to the West, to a large extent, has to be driven by investment. You invest in more productive things that are going to get you there. Now, if you have very rapid technological change, the uncertainty around longer-term investment decisions that you're going to make is picking up very significantly. I mean, to your point, Hani, the hospital with 18,000 beds in China, well, maybe 4 years from now, we find out that 4,000 of these 18,000 beds are being used to treat an illness for which we've just discovered a pill that is costing $1. Mm-hmm. So the uncertainty surrounding these investment decisions that are going to support the growth of emerging markets is going to go up, is going to take place in the context of political regimes that are going to be under stress. Clearly, they shouldn't expect too much help from the West if the current rhetoric is there. And it's going to pose significant challenges.
Let me use the last few minutes we have to throw out questions for the audience, and whether you would like to, please.
Sure. Do you think that support for SOEs, especially within China, but I'd be curious about the other regions as well, is really choking off the growth potential of private enterprise?
Anybody want to take that?
Sure. I think it's actually reversing in most markets in the sense that private enterprise is growing and the SOEs may still be there, especially the SOEs which are catering to consumers. They just can't keep up the agility, the pace, and the technological changes. So just to give you a quick example, the Indian banking sector, which is mostly public, 75%, it's come down to 65%, not because the public sector is doing anything different, but because the private sector is more proactive and growing and taking that market share. If you talk about China, I think there too, especially in the area of technology, the Chinese government has decided, they started off with the SOEs, trying to push them in areas like semiconductors, etc. And then they realized that the private sector is much better at it. So in certain sectors, I would say the private sector is moving much more rapidly than the public sector.
Please.
If you could pick one country to be opportunistically investing into, which country would it be?
Who was that directed to?
Anyone or all?
Argentina. Thank you very much. I have a friend.
Would you like? Would you like?
Two of us.
Would you like to explain why, since they've had debt crises going back to the 20s, they've reneged on stuff? I mean, the agriculture sector was decimated. What I'm saying this because
okay.
I'd like to get a real answer to this guy.
Argentina is a country that has never missed an opportunity to miss an opportunity.
Yeah, exactly.
This is a true statement for the past 150 years. So let's. I'm not saying this because I have dreams of enormous progress, but I see local currency debt at 65% interest rates. I see an IMF program, the largest in the history of the IMF, where they went all in and are going to have to double down. They cannot walk away from this thing. Mm-hmm. And then obviously on the equity side and all sorts of stuff, you're looking at valuations. It's not that they're on the floor; they're a couple of stories down in the basement. Let's put it this way: not a whole lot has to go right for this thing to go up.
Oil ship.
Yeah.
Anybody else have a favorite country? Hani?
We're doing a lot today with our healthcare business. I mean, to mention what we're doing is Saudi Arabia. So we're benefiting from some of the reforms there. There are challenges. With change, you do get challenges, but we're bullish on that market, and we're doing a lot there on the healthcare side. There's also been an opening up on various other areas for foreign investment. So that's a market that we're bullish on.
Penny? I'm going to squeeze these guys for.
We're bullish on your region, which is, investment grade region, trading with a huge premium to U.S. investment grade. It's also going to be a bigger part of the MB, the index, so lots of flows in, so we like that area. There are selected names in Africa. We've been early adapters in Egypt, obviously fueled by an IMF program. also in Nigeria and some of the smaller countries in that region. We're on Argentina. We were very much bulled up along with the two of you for the reasons you mentioned. I think the big risk in Argentina in the very short term is obviously the elections. Who's going to run? I mean, if it's a Cristina victory, you're going to be talking not about yields. You're going to be talking about recovery values. So in the short term, we're a little cautious on Argentina, but I think it could be for the second half. Once you see who's running in June, it could be a very exciting opportunity. So stick with views.
I have 5.
Whoa!
There she goes.
China, India, Brazil, Mexico, and Colombia.
Oh, that's cheating.
Yeah.
That's cheating. I mean, that's on everyone's favorite list. Pick one.
I'm a long-term investor. I don't switch too often. Pick one. Brazil.
Why?
I think Brazil is a little bit further along than Argentina. So, again, the stomach for taking the risks, I think, is a little bit calmer.
Brazil has always had the burgeoning middle class. The burgeoning middle class that never quite burgeons. I mean, what makes you so confident that Brazil will actually start to get over the hump?
I think because it has come down pretty dramatically, so there's one direction it can go. And then the cleanup of all the various corruption scandals. There's more coming out of the woodwork, but I think the big ones have been addressed. The third that I think is that despite the difficulties, the key actions like the pension reform, tax reform will happen, and this is being said by both sides, the opposition as well as the government in power. And the Brazilians, they're smart.
If I may just pick up on this, it's an interesting thing going on in Brazil. There is not a single country in history has been able to grow the dollar value of its equity market capitalization when interest rates are above 10%. And the reason is fairly simple. The hurdle rate from fixed income is so high that the equity market can just not meet it. So that's that. Brazil is now in a unique position where through a combination of doing the right things, luck, and the crisis, obviously, the deep recession that they had, that I think they could be on a 2-year glide path here when inflation remains low and domestic interest rates remain low. If that lasts long enough, we'll see. If that lasts long enough, it could for the first time actually become a domestic credit and equity story.
Wow.
And that would be very powerful. We'll see. But I think there is a window here. And I think they're also determined to grab it.
And I should add, Brazil is the most forged passport in the world because everyone on this panel could be Brazilian. So talk about diversity, right?
Yeah.
Any other questions?
Yes, I have a question regarding AI and its influence in the EM markets. I read that over 50% of all of the jobs in, let's say, like Singapore, China, South Korea, and inclusive of Japan, which is an EM, can be replaced. What would happen socially if those jobs are gone?
Who is that directed to, or should I canvass the panel?
The panel?
Why don't we start with you, Bob?
Look, it's an enormous challenge. I mean, to state the obvious, I don't have too much to add to it. It's going to be incredibly disruptive, and it's going to create tremendous uncertainty, and really, it's going to go in a sense, right? And we're going to see this in the West, but also with a vengeance in emerging markets. In a democracy, one person over 18 has one vote, regardless of his or her contribution to society or to GDP. AI is to the extent that the projections are correct, and I'm not an expert on this thing, it clearly is going to put enormous social pressure coming from the fact that employment dynamics are going to change dramatically. Add to that a very young population, and it's not going to be a very pretty picture if it materializes. Now, having said all that, this is not the first time that we are going through an industrial revolution or very significant sectoral changes, right? In 1950, in my home country, Belgium, 25% of the population worked in agriculture, and now it's 1%. Now, what worries me more than the transformation of the sectors and the economy is the speed with which it seems to happen. And that is going to put pressure on societies and political systems.
Right.
Anybody else?
I think the other thing about AI in general is that the global supply chain that's really been driving a lot of EM growth in the last couple of decades, the labor arbitrage opportunity becomes much less compelling, and people will, with AI, you'll keep your manufacturing and your front office together because you don't have that labor cost advantage of emerging markets. So I think that's a longer term negative, and it means that the traditional emerging markets business models, exporting commodities and manufactured goods, is probably broken, and you really want to focus on those markets that are making much more focused on domestic growth.
I have a different view.
Good, thank you.
I think that, when cell phones replaced fixed line in most emerging markets, people were wondering, where will this go? Will you sort of take out the middleman and all these type of questions? But, these economies actually adapted much faster than the Western economies. I also see already the impact of technology and digitization is ubiquitous across every sector, in China, in healthcare, financial services, agri-tech, and it's much more, I would say, being adapted into mainstream business than it is in the West. So watch this space.
Watch the space. Yeah. Anything? One, as a moderator, let me take prerogative to say, everyone thinks technology and AI are going to replace people, right? But that's up to the software designers. The software designers, I think, are under pressure to come up with productivity-enhancing software for all people. And the social movements that we're seeing are saying, if the education system can't give me the skills to be a high productivity worker, then I can use artificial intelligence software to amplify my skills so that I can be a high productivity worker, because if I'm not, we will have the social revolutions and other type of dysfunctional social movements that will be very disruptive. So in part, it's up to you guys to insist on that kind of design, that sort of social-minded design in software, in artificial intelligence, that you don't come up with labor substitutes, you come up with labor complements. And I think that's the challenge that's out there to all technology developers. Will you be enhancing people's performance and people's skills, or are you going to be replacing them? Because if you're replacing them, you're the enemy, and they're going to come after you. So I was told I have 5 minutes. We're going to be given the hook. I'll take one more question if there is one. Please.
Thank you. Sub-Saharan Africa seems to have a strong demographic story, but under-indexes in this conversation for all the reasons we know around corruption and rule of law. But where are you seeing green shoots that some of those things are improving? Anybody?
Nigeria.
Yeah, Nigeria, I think, is one of the areas that people are reasonably excited about. There's some other smaller countries in sub-Saharan Africa where you're seeing the beginnings of a better governance environment, and those are. But it's sort of in my market, at least in fixed income, it's sort of 2 steps forward and 1 step back. So you're really looking for the beginnings of a stronger governance environment in a place like Angola, for example, and that is the beginning of a story. But Nigeria, I think, is the biggest opportunity, and South Africa, obviously.
Do you have anything to add to that?
No.
Great. Again, please thank my panel for the wonderful session we've had. Thank you all for coming.